first we're going to pretend as if we're like interviewing for a hedge fund, and then or like some sort of quant analyst role, and we'll walk through not a simple, but a brain teaser type interview question. Next, we'll talk about like, what is the stock market? If we have time, we'll talk about a trading strategy that I had to do for a homework assignment in one of my classes, and we'll talk about how its performance. And then lastly, we'll talk about the current economic situation and what could potentially happen. So for this brain teaser, we'll introduce it, and then let's all think about it for like 30 seconds or so, and maybe we can enter what we think the answer is in the chat. And after we see some answers, we can talk about the solution. So let's say that I gave you a balance in a ball, or eight identical balls in a scale. Let's say I told you that 7 of these balls had the same weight and 1 of them didn't. What would be the minimum number of ways that you would need to do on this scale to determine which one of these balls was like the odd one out? So let's think about it for a second. If there are any questions, let me know. And then maybe you can throw your thoughts in the chat.
So just a quick question. Are we allowed to like kind of balance, like, or take one ball, put it on the other side, and then put but that wouldn't really work at all either. So are we allowed to just kind of like play around with anyway, or is there specific rules?
Let's just say that like I gave you 8 balls, like you couldn't tell what the difference in the weight was. You can like put any number of balls on either side,
Okay.
And then one of those is one way. So yeah, we're seeing a lot of different answers in the chat. I see some 6s, 3, 5, 2, a lot of 3s, 1 if you get lucky. Yeah, I guess if you get lucky on the first try, you could do 1, but let's say that I wanted you to give me a solution that would work every single time. Cool. We've got some good guesses. Let's hear some thought processes. I'm just gonna call on the people randomly who put something in the chat. So sorry if you didn't want to talk. But Alexander, you said 6. Why do you think it could possibly be 6?
I don't know, if you put like 3 on each side, like if it doesn't balance, that means you know that it's one of those 6 that you like, one of the 3 on either side, and if the scale does balance, then you know it's the one that it's the 7th ball.
Cool. Yeah. I agree with your logic there. I don't know if that would necessarily constitute like 6 ways. I think that what you're describing is more of 2 ways. But yeah, I think that was the answer. So I guess we can kind of just talk through it again. So like Alexander said, we can do this in 2 ways. And the first thing, sorry, Marek, do you have like a question, or why is your, oh, never mind, cool. So the first thing that we would do is we would take 6 of our balls, and then we'd put 3 of them on one side of the scale and then 3 on the other, and we'd keep 2 in our stash on the side. So once we did this initial way, we would know 2 things. We would either know if these 3 were equal weight, then we'd have 2 left over that could possibly be it. And if these were unequal weight, then we would know that the heavy ball had to be in one of the in that group of 3. So if they were equal, the next thing we would do is we'd take the 2 balls from our stash, we'd take the heavier one, that would be our odd ball out. And then if they were unequal, we would take the remaining 3, put 1 out. If one of them was heavier, that would be our heavy ball. And then if they were equal, it would be the one in our stash. Cool. So it looks like we passed our interview, and we now were accepted into whatever institution we were interviewing for. So let's go over some basics about what the stock market is. Does anyone know what a stock is, or could they give me an explanation?
Yes, it's a value of a company. It's like a share of a large company. So like maybe right now, if Apple were to be worth let's see, it's worth $133.87. That means I'm a part owner, very small owner of Apple, because I kind of own their stock, and I could probably make some decisions based on what they might do if I choose to go on the board, or sometimes I'm sure different companies have different rules about, like who can vote and what kind of power they have, but Yeah, basically, stock is a small little ownership in a large corporation. It's a
Yeah,
value.
yeah. Thanks, Radeep. That was a pretty good that was a good explanation. Very detailed. But yeah, I think that the key thing that Surdeep said there is that stock represents like part ownership of a corporation. And he said that, yeah, depending on like what types of ownership you have of the company, you may have different, I guess, perks or rights associated with it. So just some common examples of like stocks that you trade on a day. Surdeep gave Apple, but like other ones would be stuff like McDonald's, Google, Microsoft, etc. Sweet. So now that we know what a stock is, can anyone explain to me what an index is? Okay.
I
Yeah.
believe that an index is a evaluation of the stocks which it covers. And so it tracks the values of the stocks which is included in the index.
Yeah, so that was definitely on the right track. I like the things that the people are saying in the chat though. Like Ishan said, like a range of stocks. Alexander said a group of stocks. And I think that this idea of having like a group of stocks is a good picture to have for what an index is. And yeah, this is literally what it is. Pretty much what they do is they take a collection of stocks, they put them together. Then basically, if the stock market, hopefully this is diversified enough where there's like enough stocks in there where the performance of this index or group of stocks reflects the market as a whole. And the classic example of an index is your S&P 500, which is a market cap weighted index with the 500 leading publicly traded U.S. companies. And when you hear like hedge fund managers and hedge funds say they have this thing called alpha, what typically this means is that it's talking about how much returns they made using their strategies versus a benchmark like the S&P 500. Cool. So now that we know some simple assets that we can trade with just stocks, which are a portion of a company, and then indices, which are a collection of companies, let's talk about how we expect the stock market to perform annually or act annually. And what we call this is we call the way that we expect the stock market to behave a random walk with positive drift. So what is this thing? So let's break it down into two components. First, let's think about this random walk part. So this idea of a random walk is that, let's say that we have the price of a stock at T-1. So let's say we have the price of the stock from yesterday, which is June 14th. We would then assume that we could make that the price of the stock today on June 15th would be this price from yesterday plus some random noise epsilon that we have here, which we can think of as just like sampling from a normal distribution. So pretty much what this equation is saying is that the price of a stock on the next day is random, and we can't really model this. So what does this look like when we run a bunch of simulations? So what I did here is I took the returns of a lot of commodities. I think it was about a year or two of data. And well, I didn't actually do this. A professor did this, and then I took his code. He then took the variance in the returns of these commodities, and then he showed if you continue to like randomly sample from like a distribution here, a normal distribution, and added this noise to the price from the previous day, this is kind of like what our price trajectory would look like. I'm thinking maybe this is a little too mathy, but the only thing to take away from this is that if we just have a random walk that we add random noise to, we can we assume that over time, on average, there is no returns with this collection of stocks. But then if we add this thing called a random drift term, what we'll see is that our stocks tend to perform better as time moves on. And so the next question to ask would be, after we have this idealized framework of how we think the market would work, is does this actually apply to the stock market? And for the most part, with our S&P 500, we tend to see that we do see that the market has this this property of a random walk with positive growth. I'm gonna skip this part. I think this is too complicated. Cool. So now that we understand just some basics of how we expect the economy to work and some of the things that we can buy in markets and sell in markets, let's talk about what's actually going on in the economy right now. So I think a lot of you have heard this idea of inflation going up recently, and it definitely has. But the question then becomes, what is inflation and how do people like the Fed track this metric? And the way that they do it is they use this metric called the Consumer Price Index. And the Consumer Price Index can be boiled down to, like I said right here, the cost of goods in a time period T divided by the cost of goods in a time period T minus 1. And basically, depending on how this cost of goods changes in period T, will show whether it costs more to live in a specific country or to live in a specific time period versus a previous one. So let's see this in an example. So let's say in time T minus 1, it costs $1 to buy like a bundle of groceries. But then in the next period, time T, we saw that it cost $1.10. What we would see as a result from this is that this would show a CPI of 10% because it costs 10% more to buy the same item, collection of goods in time period T as it did a year earlier. And what we've seen currently is that over the past year or so, there's been a really, really dramatic increase in CPI, which has led to, which is why we have such large inflation. So what caused this? I think that there are like 4 main reasons that caused this. The first is that we had COVID-19, which shut down the entire economy, and we had crazy unemployment levels. And this really was a short-term issue and something that had never really been foreseen before. And this caused a lot of crazy things to happen, of course, as a result of this. The next thing is that we have all these technological innovations. I think that this definitely has influenced the inflation rate, but it's probably not the main reason. But as a result of COVID-19, what the government ended up doing is they wanted people to spend more money. So they lowered interest rates. And as a result, and also what they did is they gave a lot of stimulus packages to people. And as a result of this, we had a lot more money flowing in the economy. And what people ended up spending their money on were things like Bitcoin. And so we got all these crazy bubbles, and a lot just because people had all this money, they didn't really know how to spend. And so what the Fed is going to do in response to this is they're going to raise interest rates to limit spending in hopes to slow down economic growth, cut consumer spending, as well as increase unemployment. So if you want to keep track of like where you think maybe inflation would go, a good thing to do would be to take a look at the unemployment rates, because as more people become unemployed, they're going to have less money. And because of this, with less money, they can't spend as much, and the prices of goods will no longer increase as drastically. Unfortunately, what we see is that the employment rates are still fairly low. So I think that all this implies is that the Fed is going to have to continue to raise interest rates, which means that we will probably fall into a deeper recession, which is probably not the best thing. And just to get an idea of currently how the economy is doing, well, Bitcoin's down about 50% year to date. The S&P is down 20%, and we're now starting to see a lot of layoffs and hiring freezes in large tech companies. For instance, Coinbase has laid off 20% of their workers, which is pretty insane. Meta has started doing hiring freezes. I think that I heard Meta and Coinbase did the same thing, where they started emailing their interns like the day of that they were supposed to start that they were no longer going to have a job for this summer. So yeah, we're starting to see some pretty serious repercussions of these rising interest rates and the faltering economy.